Welcome to The Explainer. Okay, today we are diving into what might literally be the most audacious, head-scratching, and just utterly fascinating business proposal of the entire decade. We're talking about a proposed mega merger that has Wall Street completely confused and the internet totally divided. GameStop, the video game retailer that became the absolute face of the meme stock revolution, is actually attempting a $56 billion takeover of the e-commerce giant eBay. I know it sounds like a joke, right? But the filings, the funding, and the strategy, they are very, very real.
So here is our roadmap for today. First, a minnow eats the whale. Second, the $40 billion math. Third, revenue down, profits up. Fourth, the pawn shop synergy theory. And finally, a path to capitalist hell.
All right, let's jump straight into section 1. A minnow eats the whale, the size disparity. To really grasp the absolute shockwaves this sent through the financial world, we have to look at the massive, almost comical gulf between the buyer and the target. Ryan Cohen, the highly scrutinized and unpredictable king of the meme stock era, has officially set his sights on a colossal leveraged buyout. The GameStop CEO is literally trying to engineer a deal where his physical bricks-and-mortar video game chain buys eBay in a massive cash and stock offer. And this really shows you the sheer absurdity of what we're looking at. To put it into perspective, GameStop's market capitalization sits at roughly $11 billion, yet they are putting forward a $56 billion buyout offer for eBay. They are bidding roughly 5 times their own total value to acquire a company that just completely dwarfs them in global scale. Now, interestingly enough, GameStop isn't starting from scratch here. They've actually already quietly built up a 5% stake in eBay, aiming to position it as a credible rival to Amazon. The sheer mechanics of this have the experts completely baffled. Eric Talley, who is a professor of law and business at Columbia, noted that it's incredibly unusual for a small, quote, minnow company to try and eat the whale. He calls it a total head-scratcher from a textbook perspective. And you can see why, right? Because there's a complete lack of obvious synergies between a physical retail chain and a massive global digital marketplace, at least in the traditional sense. Which brings us to section 2, the $40 billion math, funding the impossible. So, if the size disparity is really that huge, how on earth does GameStop actually plan to pay for this? Well, to answer that, we've got to look at Ryan Cohen. People who have done business with him often describe him as a cowboy investor. He is definitely not your traditional suit and tie CEO. Remember, he made his initial fortune by co-founding Chewy back in 2011 and selling it for $3.4 billion. Then he joined GameStop's board in 2021, rode that massive pandemic-era meme stock wave, and completely recast the entire company.
Okay, let's break down this absolute war chest he's managed to assemble. Because despite being the so-called minnow, GameStop is incredibly well-armed. Cohen actually has access to an astonishing $40 billion in funding for this deal. That breaks down into a $20 billion financing commitment from TD Bank, roughly $9 billion in hard cash just sitting on GameStop's balance sheet, and about $10.7 billion worth of GameStop stock that they'd use in the transaction.
But wait, do the math with me. $56 billion minus $40 billion leaves a gaping $16 billion hole. And bridging that massive $16 billion gap is for sure the most precarious part of this entire master plan. I mean, under normal corporate circumstances, a gap like that would kill the deal instantly. But GameStop isn't normal. They rely on their totally unique army of retail traders. Filling this gap likely requires issuing a massive amount of new stock, heavily diluting the existing shareholders, and basically banking on what analysts are calling meme stock boosts. They need the exuberant willingness of regular internet investors to just blindly support management through some highly unconventional capital raises. Let's move to section 3. Revenue down, profits up? The Hacker News debate. Look, before GameStop can even hope to convince eBay's board to accept this wild deal, they have to prove their own house is in order. And the big bear argument, which you see constantly voiced by skeptical investors on forums like Hacker News, is that GameStop is fundamentally a dying physical media business. Critics say they're no different than Blockbuster or Tower Records, and honestly, the top-line numbers show a really steep decline. Revenue dropped 11% in 2023, then another 27% in 2024, and another 5% in 2025. One deep dive analysis actually pointed out that their trailing 12-month revenue is down 66% from 2012 in nominal dollars. Ouch. But here is the massive reality check that completely scrambles that whole narrative. While critics love to call it a dead business on fumes, GameStop actually just reported an operating income of $232.1 million in the recent fiscal year. So wait a minute, how exactly is a company with consistently shrinking revenues suddenly generating hundreds of millions of dollars in pure profit? Well, the answer is that GameStop is behaving way less like a traditional retailer these days, and a lot more like a massive treasury fund. They achieve that profitability not by somehow selling more video games, but by aggressively cutting costs, ruthlessly shutting down their unprofitable physical storefronts, and earning massive amounts of interest on that $9 billion pile of cash. And remember, that's cash they raised by smartly issuing new shares right when their stock price was artificially inflated by meme momentum. It's honestly brilliant financial engineering, but critics definitely argue it isn't a sustainable long-term growth model. Section 4. The Pawn Shop Synergy Theory, the Master Plan. So this brings us to the really fascinating why behind this whole deal. Out of all the companies out there, why does GameStop want eBay? Well, look at eBay today. It is a massive, incredibly lucrative global marketplace, yes, but let's be totally honest. It's been viewed as a laggard in innovation for years. They've been slowly losing ground to frictionless platforms like Amazon and newer apps like Vinted. The single biggest hurdle for eBay has always been the immense friction for the individual seller. Think about it. The hassle of taking good photos, writing detailed descriptions, handling customer disputes, and then boxing up items to go ship them. It's a lot of work. And that all builds into this incredible operational theory that's being heavily championed right now by the retail investor community. Check this out. GameStop is actually already legally set up as a pawn shop in every single US state. They already have the technology right there at the counter to plug in a used laptop, wipe it, and run automated diagnostic tests. So imagine a world where you just take your unwanted items, old electronics, games, collectibles, directly to your local GameStop. The staff authenticates it right there, hands you cash on the spot, and then GameStop bulk lists all those items on eBay from a centralized warehouse, completely skipping the nightmare of individual shipping costs. The absolutely crucial point here is that this instantly solves eBay's biggest friction problem by utilizing GameStop's physical stores as local edge nodes. Plus, this creates an unbelievable authentication ecosystem. Think about the booming secondary market for things like graded Pokemon cards, luxury watches, or high-end sneakers. Currently, eBay charges around a 13.25% commission, but by merging, GameStop provides a trusted physical footprint where items can be verified in person, totally bypassing traditional seller hurdles and creating a massive structural advantage over Amazon. It's actually kind of genius. Finally, Section 5, a path to capitalist hell, the verdict. As brilliant as that whole pawn shop theory might sound on paper, the financial realities of executing a $56 billion takeover are incredibly dark. Legal scholars and financial analysts are sounding major alarms. Ann Lipton, a law professor at the University of Colorado, noted that while she can sort of see the investment thesis, the upfront financial commitment is just way too massive. She points out that this deal entirely relies on those meme stock boosts to fill that $16 billion gap. And frankly, those boosts currently just do not seem to be materializing. The reality is, the retail investors might simply be tapped out. And then we have Michael Burry, the legendary investor from The Big Short. He had previously been one of Ryan Cohen's really prominent supporters. But upon seeing this eBay proposal, Burry abruptly announced he was likely dumping his entire GameStop stake. He warned that taking on billions in interest expense and restrictive debt covenants isn't breaking new ground at all. In his words, quote, "It will be trotting in well-worn ruts on the road to capitalist hell." So, the battle lines are firmly drawn. When Cohen recently went on CNBC to pitch this deal, he ended up basically sparring with the hosts. He offered very little detail on the actual financing, which of course resulted in the mainstream media immediately labeling it a doomed stunt. Meanwhile, Cohen's army of retail supporters took straight to social media. They're calling the coverage a total hit job, and they are quickly reminding everyone that GameStop went from being a heavily indebted company trading at $2.50 to sitting on $9 billion in cold hard cash. They fiercely argue that you should never, ever bet against the cowboy with nothing to lose. Which leaves us right here. Is this proposed $56 billion acquisition a brilliant masterstroke by a cowboy investor who sees a physical synergy that literally no one else does? Or is it just the ultimate delusion of meme stock madness, destined to drag both of these companies straight into capitalist hell? That is exactly the question Wall Street has to answer. Thank you so much for joining me on this explainer. Keep questioning the consensus and keep digging into the data.